All right, I'm getting close to chips. I have no lunch in here to go.
Okay. Hello, this I will share some of the information about U.S. individual tax return, which is for Form 1040. It's for the IRS federal tax return. And that's start. Okay. The first one typically is Form 1040 instructions. Normally it's available in the IRS website around December. So sometimes I check it see if anything's changed, or maybe I can adjust my last payroll for the tax. I don't know, depends. So it's up to you. That's how I normally check my tax for the year and make sure I don't overpay or something. Then I can. Okay. Anyway, so for 2022, the due date is original due date is April 18th, because I think April 15th kind of like a holiday or something like that. And then with the extension, it will be October 15th. But George mentioned that because of the California disaster announcement, it could be June 30th or June 15th, something like that. So, and then the next one is one of the other changes, normally one of them is called qualifying withdrawal. Now in 2022 tax form is changed to be qualifying surviving spouse. And the next one is standard deductions increased by 12,950 for single or married filing separately, and 25,900 for the married filing jointly and qualifying surviving spouse. And then 19,400 for head of household. Next year will be increased a little bit much more, about $900 for the single, and about 2,000 for the married filing, and then about 1,400 for head of household. And before 2022, I think in 2021 prior year, some of the income was reported has to be reported in the schedule one, but in 1040. But starting 2020, some of those are shifted into the schedule one. For example, like a scholarship, fellowship grant, pension annually. Those are reported in the schedule one instead of 1040. And something we just or in the jail prison. So you can find those details in the IRS, but it may not be applicable to us this way. And for the reduction,
Oh, I mean, okay. Now you can join. Hey, there we go. Okay, thank you. That's well. There you go.
thank you. And the other one's like a change in reduction. So in 2021, because of the American Rescue Plan Act of 2021, and which is mostly related to the COVID-19 relief, and those like a child credit for the child and dependent expenses and child credit and all those are like an increase in 2021. But in 2022, because Congress didn't approve to extend it, so we are back to kind of like a normal reduction, which is like a for the child and dependent care expenses, it will be like a 2,100 instead of 8,000 in last year. And also for the child tax credit effective at 2,000 instead of 600 last year. And the other ones are earned income credit, same thing it has a more limitation in 2022. And one of examples is like a must have a qualifying child. And then if no qualifying child, the spouse or spouse, it must be like a over 25 and then under the 65. I think before the limitations a little bit much less. And the other one reporting rules because of the one 1099. Normally like a third party networks are reported only for over 200 transactions and then aggregate amount of 20,000, but in 2022, they have to report every single transaction which above exceeding the 600. That means some of those are transactions from the bank transaction, something like a gift or salary payments or whatever, those could be reported if over $600. But you don't have to report it as income if they are fall under the forcement gift or reimbursement of the other expenses, something like that. All right, these are the kind of summary for the changes. Oh. No.
I think I have to use the mouse again.
Okay. And for this one, like, if anyone under the gross income less than 73,000 or less can be used like a free e-filing in the, from the IRS, like I think it's an outside third party program, something similar to the carbon tax. But I don't remember the name, but, if anyone under the 73,000 eligible for the free tax return. Okay. And filing requirements are not everybody required to file the tax return. And there are three criteria, and then most people you will see like for single, if you are under age 65. We do. How do I find it?
We have it.
Okay. All right. So if under 65 and it's a 12,950, then you have to file a tax return. If it's under 12,950, you don't really have to, unless you have like a tax withholding from your W-2 form, like a federal tax or something. Normally, sometimes if you have it, those you may want to file it for that to get a refund back. And if it's over 65, you don't need to file it. If it's under 40,700, so and so on for each category. And then you can see like a more detailed explanation at the bottom. All right. And the next one is a chart fee. So this is a more detail about it. It's regarding to the children and other dependents. So if you are single dependent, you don't have to file it. If your unearned income is less over $1,150 and then was over 12,950, then you have to file it. And you can see like a gross income more than or larger of 1,150 or 12,500. And then if it's yes, you must have to file it if it's those above those threshold. You will see all these. So it's for each like a single marriage and doesn't say anything about the, because normally like a children or dependent could be like a single or they could be married and then one of the child is a married and then can be dependent on the parents' tax return. But those children, dependent child have to file their own tax return if fall under this category. Like at the bottom, the last one, if you earn is over 2,550 or 14,350 and so on. So if you are under those limits, you don't really need to file tax return unless you have like a income tax withhold in your W-2 form. All right, and the next one, the third one, so you can see, or if anyone fall in this category, have to file the tax return like a alternative minimum tax and qualified pension plan and so on, so social security tax and then net earnings from self-employment at least $400 and so on and so on. And the next one, okay, filing status. For the single, there's a type single means like if married people could be a single, but if the divorce not finalized at the end of 2020, they are still considered as a marriage, even though they live apart or they are in the process of divorce or separation. And then the other one is like a qualifying surviving spouse with a child can be claimed as a single or qualifying surviving spouse. and married filing jointly, so you will see all the four categories. So if you are married at the end of 2022, even though if you don't live together, you're still married. And spouse died in 2022, and then you didn't marry in 2022. And married in 2022, and spouse died 2023 before filing 2022 tax return. And the good benefit and drawbacks like if it's a married filing jointly, both are responsible liable for the tax, even though for your spouse. So if your spouse cheated and then didn't report correct amount of payroll or tax anything, and then didn't pay for these tax, then you are liable and responsible to cover those taxes. Otherwise, federal will come after you, even though it's not your fault, it's a spouse fault. So, so some people do the married filing separately because of their income tax table. I mean, bracket like if you have a higher income and lower income like a couple, and sometimes it's more beneficial to have a separate income. So you get to pay on your own tax and not to the other tax. And then, but in that case, only individuals liable and responsible for the home tax. So you are not liable for your spouse tax liability or anything. But the other drawback is normally their tax filing sort of like a tax rate is much higher than any other category. For example, like even single, if it's a single, it's much lower than that is married filing and separately tax bracket. And the other thing is it doesn't allow you to deduct the student loan interest deduction or no education credits. And earned income credit, those are also limited too. And then one other thing is like a married filing separately, if that one spouse use like a itemized deductions, you cannot use a standard deduction, even though your standard deduction is higher than itemized deduction. So both have to use the same deductions. So it could be not benefit for the one of the spouse, which are lost like a standard deductions. All right, and the next one is head of household and has to be unmarried and provide a home for a certain other persons like a dependent. So unmarried means like a legally separated by the state law, married but live apart at least last 6 months and meet other rules, and then married a non-resident alien who did not enact as a resident alien. Okay, for this one, sometimes in the couple, one of them was a non-resident aliens, and then this person can be elected as a resident alien, and then one US citizen or green card resident alien plus this non-resident alien can be filed as a marriage filing jointly, but has to be elected. In this case, if the person is not elected this feature, then it can be filed as a head of household, unless it has like a providing a home for certain persons. And then provide means like you pay over half the cost of keeping up a home and main home for order 2022. Example for parents. Parents can be claimed as your dependent if you can prove that you maintain or support half the cost of keeping their home. And even although also you pay over half the cost of keeping up a home where you live and dependent live for more than half of example like your child. And the child could be claimed as a dependent or not dependent because so it doesn't matter, at least as long as this dependent live with you for more than half of the year. And for not dependent child, it must fill in the child's name on the form. So IRS can verify and follow these. And the next one, qualifying surviving spouse. If the spouse died in 2020 and 2021, and you didn't remarry before the end of 22, you will be qualified as this one. But if you remarry, that means that you will become like a married filing jointly on the other category. And have a child and a stepchild and not a father child. And the gross income is should be less than 400, and then so you can still qualify as qualifying surviving spouse. And if spouse died in 2022, you are not in this category. You will be in category like a married filing jointly automatically. So, and I think in the tax bracket, just qualifying spouse and head of household and married filing separately as in the better tax rate, I mean lower tax rate, but the highest one for the married filing separately, and the second highest one is for the single. All right, and other notes is like if you get a qualified dividends or capital gains from the 1099, and then it can be a lower tax rate. It's subject to the like a taxable income. It could be taxed at a 0, 15, or 20%. So you don't really have to put it, or you have to recalculate it to get this a lower tax rate benefit. And the other one is that if it's like a in a tax table, like you can find a number up to like a lower than a 100,000. But if it's a 100,000 over that, you have to use the tax table. And the rule is that you need to keep your tax return, all the worksheets and all the records, and at least for 3 years, which is the 3 years from the date of tax return was filed or due, or 2 years from the date the tax was paid. For example, you filed a tax return in April 2022, you have to keep it up to April, May 2025, and some of the time, sometimes you do the extension, and then it could be like a starting from that extension date of the payroll, I mean tax return filing due date. And another one is the amended tax return 1040X. It must be filed within 3 years after the date the original return was filed, or within 2 years after the date the tax was paid. But sometimes it can be extended because if you live in like a federally declared disaster area or physically or mentally unable to manage your financial affairs. All right, that's all I have in the note. But the other thing is like a few things is like for example, like a pre-tax deductions. I think we have like a setup in our payroll like a FSA, like for those medical expenses, they use it that kind of like a saving account. You deposit in there like a before tax, so you don't have to pay the tax on that one. So I think I don't remember the limit. I think 2,500 or something, but that one can the balance kind of like a use or lose it. But I think you can carry over to the next year for if it's 500 or 550 or something like that. So, and the other ones are those are with the children. We also have like a child care dependent, like a deduction, like a saving account. I think that's a little bit higher, like a 5,000 or something like that. You can save it in there. So if you have a daycare center, you can use it and pay out of that one, which is a free tax. Because you can claim it in the tax return as well, but they have a limitation. So if you exceed, normally like if you have a high taxable income, you may be disqualified to claim those credits. So the safest one that have that free tax deduction, and then that one has no limit. So if you deduct it from your paycheck, then you use. I think that one's also used on Tuesday portion too. And the other one is IRA account, individual retirement account. We have a 401k plan. So it's also like if you have I think there's a taxable income has a threshold. I think for 2021 is 120,000, and I think for 2022 this year and next year tax filing will be I think 130. So if your income is lower than 130, and then you can recalculate your 401k account and then see you may be able to do additional IRA deductions after you find out that, oh, I may owe taxes. But the safest way is that you contribute a much higher like a 401k account, so it's safer. And then, but the drawback is you may have a less pocket money because of those are deducted already. So, and for that IRA deductions, for the married filing jointly, if your spouse is not working, or if your spouse incomes are much lower and then he or he doesn't have a 401k plan, they they may be able to contribute maximum IRA deductions. I think in 2022, it's a 6,000 for those people under 55, and then over 55 will be 7,000. Next year, I think 2023, it will be 7,500 for over 55 years old people, and then I think 6,500 for under 55 years old. So you may want to take a look at that one when you do the tax return, because sometimes if you the trick is normally if your taxable incomes are getting higher and higher, your tax brackets will be higher and higher too, because that's one of the beauty or one of the drawback in the American US tax law, because it's go by the hierarchy. So if your income higher, you pay more tax and I think in Europe, most of them are kind of like a universal tax rate. So it doesn't care you have a low income or you have a high income, you're paying like a much higher fixed rate. So they are kind of, I think that's how it is. So they are much simpler, but American has this rule so typically those people looking for the threshold loophole or whatever, they want to reduce their taxable income. That's what Trump or whoever did, right? So they get all these deductions. For individuals or the other ones that you may want to look at the IRS deductions, especially if you are married, and then you may want to take a look at. So sometimes for example, you contribute $5,000, your tax bracket may be lower than your tax rate and say you maybe $2,000. So technically, it doesn't contribute 3,000 because we got a 2,000 saving from that. So take a look at that one, especially if your incomes are higher and higher. That's a change a lot. I think that's about it. That's all I know. And California, I think most of them are comparable with the US, federal tax return. It used to be they used to have oh, you can deduct it in a 1040. We are not allowed to deduct it in California, blah, 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 something like that. So I think most of them are comparable now. So, one thing is if you have a federal, T-bill or T-notes, you have to pay the tax on the federal income for those interested. You have to pay into there. But when you file in California, you can deduct it from that. So you don't have to pay the tax on those. So if you have those T-bill, T-bonds, a lot of savings, you may want to take a look at it. And you may remind your tax accountant if you know you have those things.
What is it?
Treasury bill and treasury bonds.
Oh,
Yeah, because under the federal law, they tax you all those interests. They pay you, but under the California, they are tax exempt. So you don't have to pay on those.
oh,
Yeah. And anything like a California lottery, right? So federal will tax you, but in California, you have to deduct it back, so you don't have to pay the tax.
Oh, if you don't allow to, you don't have to pay tax.
No, California don't tax you on that one. Only for California lottery, I think. Or maybe Powerball too, I don't remember. So those are a little bit different from that one. And most of them are comparable. Right? Thank you, and then that's all I have.
very timely presentation.
So your IRA is over. And they go to
Your retirement account,
401k and IRA, they are not really, you can still fulfill your max for the 401k and then you can also fulfill the IRA, they are separate.
no.
Right.
Do I need to stop it or?
No.
401k is deducted from your paychecks, right? And IRA is kind of you pay from out of your pocket.
Yeah.
So it has a limitation, I think in 2022 is 120,000 taxable income. So if you are above that one, I think you can still contribute some kind of like some amount of IRA, but it's not going to be a full amount. Because it's kind of like you have to recalculate but if you're under 120,000, and then you can contribute, I think that maximum amount for the IRA, even though you have a 401k plan. But typically, you won't be qualified because it's very low, so like engineering and all these, their income. Because it's not just a paycheck, right? So you also have like a interest income and capital gains and all these other stuff. And so if you have all these saving costs, and so it added up, and then your tax rate income may be higher. So, and the best things like if you can afford, trying to get maximize benefit from the payroll deduction. So like a 401k deduction and FSA account, child dependent care, so they'll get right away.
But FSA, you never know, right? So just because you said you can only carry over $500.
Yeah, and normally what I do is like I think about my next year or this year plan, like, okay, I'm going to do my dental work, which will cost, I mean, our guardian will not cover for this one.
Yeah.
So I just guesstimate, okay, maybe it's $600, okay. And I'm going to get a new frame, so it may cost me like $400. So I just add up and then think about for your spouse and for your child, and okay, add it up, and okay, that one is. It's kind of like a campaign, and you have to guesstimate it, and the same thing for the child care and that one. So, but that one's easy to test, right? Because you know how much money you have to pay for the daycare center, so you just.
Yeah, because Joseph is out there, that's another financial question. Like, really, does the 401k make any sense with this type of economy? Because I see, I mean, a lot of people, for example, in 2021, if they were to retire here, 2021, if I have mentioned that I'm in my retirement age, I saved all my money in 401k, and then I'm looking at, I want to take it back, and then I see there's a loss. That is a lot of different opinions I get. I'm not a financial expert, that's why I see. Some people say whether it's during the recession or not, 401k only during recession it can be like the situation, but it depends on what's going to happen at your retirement age. Right, that's one way of looking at it. There are some groups which believe the ultimate 401k is all there is. It's not really profitable. Maybe if you really think deep. I mean, a lot of people talk about maybe it may be profitable, but a lot of this money goes to the agencies which are maintaining this 401k in terms of the hidden part. I mean, I don't know. So, is it really suggest to be putting in 401k or money or not?
I think the main point about 401k is because the company also incorporates the money, so it's not only your money. Like
Well, that limit, I agree. That's good. Until that limit.
you can go whichever plan. Certain companies, they can match up to like 10%, 15%. Here they match up to 4%. That's the extra money that you get to put in your saving account. And then you can pick how you want to change. You don't need to put it into IRA. You can change it, and then they invest your money. You can pick the different investments to be safer. So I don't think 401k is more has benefit than has, I don't know, like the way that I have experienced it, it was more investment for me than just like being reducing your money or getting taxed. Also, it's going to be reducing your income, so your income is going to be less taxable. So I think that's the benefit of the 401k. And also it's a saving for your retirement, so you don't need to change it until it's safe and it's the least amount of like taxable thing.
401k is kind of like a long-term investment, right? You have to look at it. So the other things are like is one thing that is reduce your taxable income, and the other things that normally I don't know like your deduction for each paycheck won't be like 10,000 or 5,000, right? It could be like maybe 500 or 200 or 300. So it's kind of like an investor like over the period in the less amount, right? So if the market is going down, you invest, you get more shares. If market is going up, then you get a less share. But like you said, like your balance go down because of the market crash. But think about it, like okay, normally like, I don't know, Joseph, you can call it like to me, like the market is kind of like going up and down, up and down. If it's like 10 years or 15 years, you still pay more than bank account. That's what I feel like, I had an argument with my wife like 15 years ago, and we did the same like an IRA contribution, and then she got scared, and then those crashed, and then she said, "Oh, who bought my money?" And then so she took it, and then put it in the Wells Fargo CD accounts. I left mine there in there. Now mine kind of like 10 times now, and how Wells Fargo is still like
Is your account, mutual or joint community, a community property with your?
I think all of us are in a joint community unless you really like go to a lawyer.
So she didn't really lose it.
Yeah.
Investment.
She still has me, so she only my portion. So to summarize, to me, like this one should treat it as a long-term investment. And if you see like your investment going down in the previous year's job or whatever, you may not have to like withdraw it right away. You can leave it there. Unless like if it's under 5,000 or 1,000, whatever, they have a threshold, like as soon as it reaches those below that level, you have to take it out right away. But if it's above those, you can leave. That's what I did for my previous job too. I look at when the market is up, and when the market is up, I took it out. So
But 401k is like it's stuck, right? You're not able to take it out until.
it's
you're-
like a
you're
retirement
in
account,
it,
right?
right? Maybe
Individual retirement.
62, 39 and off or something like this.
Yeah, so until then 70 years old now, right now it's like, oh, you can, well, the other thing is you can withdraw earlier, but I think until 55 or something like that, but you have to pay the 10% penalty. So after the 55 or 6, I think 55, you can start doing the withdrawal, but you have to pay the tax though.
But this penalty is applicable for everybody, like for example, if somebody is taking money from 401k for a
Normally,
home purchase, for instance.
well, those cases, some people do their 401k loan, right? You don't withdraw it. So 401k loan, that's not taxable, no penalty, and you pay back.
And you don't yourself, so the interest comes back to you.
Yeah. So
And you
something
can
like
get
that.
up to
So-
50K loan off of your 401K per year.
Some people treat their 401k account like that, so they chip it in and then they withdraw it for, or borrow it for something else. But to me, it's not good. Why do you use these features? I mean, that's why 401k is supposed to be your long-term savings.
They don't have any other money, that's all I
Yeah, and one drawback for IRA is that you cannot borrow it back. So if you save it, it's stuck in there, so you cannot take it out anymore. 401k benefit, like you can borrow it as something like that.
This works out good.
Yeah, so that's why like some people roll over into their 401k right away because they can borrow it back. Because if you left previous company,
Yeah.
you cannot go back and borrow that money. It's stuck in there. It's like an IRA account. It stays there. You cannot touch it anymore unless you withdraw that or transfer. But as soon as it comes into your current 401k plan, you can borrow it.
But the rollover, does it involve charge?
Yeah, global is allowed to be borrowed too.
But there's a charge for that, when you roll over, or just? Do
Sorry?
they charge you? The 100%?
Well, normally like they charge for the $50 or something like for the transfer fee or $100. I don't know, depends.
Mine was no charge.
Sorry?
Mine was no charge.
Yeah, depends, right? It depends on the plan. Some plans are very generous at that company pay for it. Some are kind of like a economy or whatever you call it. They charge you those things.
Or you have to transfer to the current.
If you want.
If you want it, if you want to use it, you have to borrow it. But if you don't need it, you can leave it there. And it depends, right? Also like it depends on the investment. Sometimes like you may not like our current investment, fund, and then if you prefer the old one, you can leave it there. Because after you transfer, you have to invest in our current plan, investment plan. You cannot use the old one. So. Yeah. Okay. Thanks. Thank you.
Thank you.
Oh.
It's rabbit. Something wrong with my camera. I can only show my background. Thank you. Very good topic.
Yeah.